In April 2022, Netflix shocked the market by losing subscribers for the first time in over a decade, breaking a growth streak that had defined the company's entire success story. The platform reported a loss of 200,000 users in a single quarter and projected that up to 2 million more could leave in the following months. This was not just a bad quarter. It was the moment the system that powered Netflix for years started to reverse direction. For a business built entirely on continuous subscriber growth, even a small decline meant the model itself was under pressure. Within hours, the stock dropped around 35%, wiping out tens of billions in value as investors rushed to reassess what Netflix had become. The reaction was immediate because the assumption of endless growth had suddenly disappeared. At the same time, competition had intensified, content costs were rising, and users now had more choices than ever before. Netflix was no longer expanding into an open market. It was fighting to hold its position in a crowded one. What looked like a slowdown on the surface was actually the first clear sign that the growth model had reached its limit. The turning point became clear on April 19, 2022, when Netflix released its quarterly earnings and revealed a loss of 200,000 subscribers instead of the expected growth. Even more concerning, the company warned that it could lose up to 2 million additional subscribers in the next quarter, signaling that the decline was not temporary. For the first time in years, the direction had changed, and growth was no longer supporting the business. Netflix had always relied on adding new users to fund its increasing content investment, and that engine had now started to stall. As soon as this became visible, investor confidence dropped sharply, triggering one of the biggest single-day declines in the company's history. The stock fell by roughly 35% in a single session, reflecting a sudden shift in how the market valued the company. This reaction was not driven by one quarter alone, but by the realization that the growth story itself might be over. Without consistent subscriber expansion, the entire financial structure behind Netflix began to look less stable. What had been seen as a temporary slowdown quickly turned into a clear signal that the system was entering a new and more difficult phase. Netflix's model was simple on the surface. People paid a monthly fee to watch unlimited content. Behind that simplicity was a powerful loop that drove growth for years. More subscribers meant more revenue coming in every month. That money was used to produce and buy more shows and movies. More content attracted more users, which increased subscriptions again. This cycle allowed Netflix to scale quickly across multiple countries. By 2021, the platform had grown to over 220 million subscribers worldwide. Investors believed this loop could continue expanding as Netflix entered new markets. The entire business depended on one assumption: subscriber growth would never slow down. As Netflix expanded globally, the cost of keeping users engaged started rising sharply. By 2021, the company was spending over $17 billion a year on content. That level of spending was necessary to keep the platform fresh and competitive. New shows and movies were not optional. They were required to retain subscribers. However, growth in key markets like the US and Europe had already begun to slow. Most households that wanted Netflix already had it, leaving fewer new users to acquire. At the same time, expenses did not slow down. They continued increasing each year. This created a gap where expenses stayed high while subscriber growth began to weaken. The system was now relying on growth that was no longer guaranteed. As growth slowed, competition increased across the streaming market. New platforms like Disney Plus and HBO Max entered with strong content libraries and aggressive pricing. Users who once relied on Netflix alone now had multiple alternatives. Time spent on Netflix began splitting across different services. At the same time, password sharing reduced the number of paying subscribers. Millions of users were watching without contributing to revenue. Netflix responded by raising subscription prices in several regions. Higher prices improved revenue per user, but also increased the risk of cancellations. The balance between growth, pricing, and competition began to shift against the model. By early 2022, the model reached a point where growth could no longer keep up with rising costs. Subscriber numbers stopped increasing, while content spending remained at record levels. The system that once funded itself through expansion began to lose that support. Without new users, each additional dollar spent on content became harder to justify. Investor confidence weakened as the gap between cost and growth became more visible. The expectation of continuous expansion was replaced by concerns about sustainability. Netflix could no longer rely on the same formula that had driven its success for years. The business had shifted from scaling efficiently to managing pressure. At this stage, the model had reached its limit, forcing a change in direction. After the April 2022 report, Netflix's stock dropped around 35% in a single day, reflecting a sharp reset in expectations. The decline continued over the following months, with the stock losing more than 60% from its previous peak. The market was no longer pricing Netflix as a high-growth platform. Instead, it was being evaluated as a business facing slowing demand and rising costs. Content spending remained high, but the return on that investment was becoming less predictable. The company now had to operate without the rapid subscriber growth that once supported expansion. This shift forced management to reconsider how the business generated revenue. The model that had driven success for over a decade was now under pressure from multiple directions. What had changed was not just performance, but how the entire system was valued. In response, Netflix began reshaping its model to operate under slower growth conditions. The company introduced an ad-supported subscription tier, adding a new revenue stream beyond subscriptions. It also moved to limit password sharing, converting non-paying users into paying customers. These changes shifted the focus from pure growth to improving revenue efficiency. Content spending became more selective, prioritizing projects with stronger return potential. The business started operating with greater discipline around costs and profitability. Subscriber numbers stabilized, but the expectation of rapid expansion did not return. Netflix was no longer scaling at the same pace. It was adapting to a new phase. The case showed that even simple growth models can reach limits when costs rise and expansion slows.